Glad to know you're still with us. The Nigerian stock market posted its strongest performance in over a year as the NGX All-Share Index gained 16.57% in July 2025, printing its best monthly return since January 2024's 40% surge. The All-Share Index closed the month at a record high of 139,863.52 points, up from 119,978.57, adding 19,885 points. Similarly, market capitalization rose by 12.47 trillion naira to 88.43 trillion naira. Driving the rally was a rare uninterrupted 22-day bullish streak, which surpassed the 14-day run seen in January 2024. What factors drove this momentum and how sustainable are they? Well, Nabila Mohammed, investment research analyst, Chapel Hill Denham, joins me to unpack this. Thank you so much, Nabila, for joining me today.
Thank you for having me. Good morning.
Good morning to you too. Well, the NGX 16.57% gain in July is the second best monthly performance since January 2024. We understand several factors have been identified, for this, but which of them do you think sort of stands out for you or to you?
So the major factor I would attribute to the rally that we saw in July is the fact that we already anticipated a recovery in the non-banks and the non-financial space. That we're looking at industrial, we're looking at consumers, we're looking at the breweries, we're looking at telcos. So all these names were expected to recover on the back of the stability that we have had relatively in FX since the start of this year. Now, and that is really what we noticed. We started to see them post very strong numbers. In fact, some of them even returned to profit because of some of the transactions that they did last year to, clean up their books and reduce their FX-related obligations that, were dampening their performance in terms of earnings. So we saw that in the likes of international breweries. We saw very strong recovery in names like Nestle, in NGX. Just to mention but a few, that's really the major factor that drove that, and there was already that anticipation on the part of investors, and that was why we started to see them take positions with the low valuations, cheap valuations that they noticed, because they anticipated that the recovery would be very strong, and that is exactly what we saw. And that really contributed to the rally that we saw sustained through the month of July. Aside that recovery, there are also other factors that supported the performance that we saw on the NGX in July. And some of all those other factors include dividend announcements. We saw some dividend announcements from companies that had not even paid interim dividend for some time, but now came back to announce dividends for the interim period. That's for the H1 25 period that they announced their results. And all that is bodes well for investors, because we're talking returns to the investors or to the shareholders at the end of the day. That supported earnings as well. So those are the key factors I believe really fueled the performance that we saw across the equities market in the month of July.
All right, we know a couple of results were released in July. You also talked about that, and why it is believed that, first half earnings sort of contributed to the bull run we saw in July. I'd like you to talk to us about some of the results that stood out for you, how investors are reacting to them, and your outlook for these outliers. I know you've mentioned some of them. You talked about international breweries, but just talk to us about some of those, the ones that you think are outliers and, what we should expect moving forward.
So the one that really stood out for me was MTN. Beat market expectation. And even though we had already factored in the fact that there was this tariff increase that the company or the telcos generally enjoy, their performance came out quite strong. And what we noticed was that across board in the market, analysts were expecting, strong performance or strong numbers, but MTN really surprised them because of how they performed across metrics in terms of their revenue, in terms of their EBITDA and EBITDA margins, and even the company itself during their investor calls, we also mentioned things around what they intend to do to sustain this trajectory. So that really is one company that I believe really stood out for us in terms of performances. Yes, if we look at Q2 25 standalone for some of these names, their Q1 numbers were much stronger compared to Q2. So I'm looking at the likes of Nestle, the likes of international breweries. They did do well, looking at it from a H1 25 standpoint. But if we look at it from just Q2 standalone, it was not as strong as we saw in the month first quarter of 2025. So these are areas that I believe in the coming quarters they are definitely going to do well, because as we know, Q4 is like a period when we really see these consumers really do well because of all the festivities and how their volumes improve in terms of sales. So we'll definitely see them post much more stronger numbers. Overall, in year 2025, we're going to definitely see strong numbers from the non-financials because of, number one, the recovery, that's the low base that they are coming from, recording losses and losses after tax, and the recovery that we're seeing with the stability in FX. We're going to see them post strong numbers. I wouldn't even be surprised if I see that some of these, this recovery that we're seeing would lead to or result in dividends being paid to shareholders. I mean, for the likes of Nestle, it's almost like third year running that they haven't paid dividends. So it will be interesting to watch how they sustain these current levels that they have started this year and see if it will translate to dividend payments to shareholders, at least in next year. That's at the earliest. I wouldn't be surprised if I see the likes of MTN as well also come to announce dividend, and all this will be positive for not just the company, even the shareholders in terms of return.
All right, so looking at sectoral performance, industrial did very well. When we look at what it did, when you compare all the sectoral performance for the month of July, industrial, of course, is the biggest, or let's say the best performer. And so far, we're seeing industrial. Every day, it's always coming out top on the list. Is that where we should be putting our money now, or are we going to get into a bull trap someday soon? I mean, let's get your thoughts on that.
Definitely, we saw strong numbers as well from the industrial goods sector. I mean, the first that we started to see rally was WAPCO, and we know since their announcement with for the acquisition by Fasting, we have started to see them become more operationally efficient. And that operational efficiency has unlocked a lot of profit and unlocked a lot of earnings. So we are seeing investors just taking positions in that name. And that also followed through when we started to see results from the likes of Dangote Cement. We saw their results also come out quite strong for H125, and that resulted in a rally that we saw in the name. If you recall, Dangote Cement at some point last year in January was trading as high as 700, but it came down to well below 400. And since we saw that their performance was quite strong, I mean, the levels that it was previously, that before it rallied recently to over 500 levels, was an attractive entry point for investors. And I believe investors already anticipated that with the results that we saw with Lafarge, and just took positions immediately so they do not be left behind. Now, in terms of entering a trap, we understand that this period is really the period where there is that expectation for earnings to be strong, for earnings to be better, and investors just took advantage of the cheap valuations that or the depressed prices, and they want to put it that way, and position themselves adequately. Yes, as with any market, when there is a bullish run, it is just natural that we start to see some investors book some of those gains that they have enjoyed over the period. We like to realize some of those gains that they've enjoyed over the period. It's natural. So we may see a slowdown as we start to see the catalyst that this earnings season has come with fade out. But if the momentum is sustained in terms of improving earnings by these companies, and we are seeing the macros also supporting the improvement in earnings for these companies, we'll definitely see that the re-rating is just the beginning. This is just the beginning of the re-rating, but I would not be surprised if I see some investors try to realize some of the gains that we've enjoyed over this period of this bullish run. But again, if the momentum in terms of earnings is sustained, the macros are also supportive, we'll definitely see them churn out more earnings, more returns to investors at the end of the day.
So what's your rating? Are we buying, holding, or definitely not selling?
No, not selling, but being cautious is what I would say, and selectively picking stocks that are fundamentally sound. You can also do some rebalancing of your portfolio to see where you would realize some gains and also channel those funds into areas that we feel are currently cheap. Because I must say something, I believe that it's not just the absolute price of a stock that investors really should look at. We should look at how much these companies have improved their earnings over the period. Because with improved earnings, we definitely see that the valuation starts to look like it is cheap. And that is when, if you're looking at it from a valuation standpoint and not necessarily the absolute price itself, you would understand that the earnings season has really presented a new opportunity for investors that look at valuation to take positions in fundamentally sound ones. So being cautious is really what I would recommend. But again, you can realize some profit. I mean, it's not that we just be looking at the gains recorded on paper and we're assuming that it will remain like that forever. Take some profit and come in again when the valuations are attractive.
Right. I want you to just talk a bit about brass cement, because at some point it's reached its 52-week high. That was even last week, and I think it has even exceeded that. Are you expecting more upward movement? Or maybe you talk to us about your target price for it.
So for brass cement, I would say we are a bit cautious with that stock because of how low the free float is. It's not as liquid as all on its other peers, so one would expect that this investor in there should be cautious. However, if we're looking at it from their performance standpoint, it is relatively strong. I mean, if we looked at the activities or the movers or the stocks that really move the market performance, whether it is from a July standpoint or even from a year-to-date standpoint, brass cement, was one of the top 5 stocks that moved the market or contributed to the gains that we saw the ASI record. So from that standpoint, that market cap standpoint, yes, we see it pull its weight, but then again, it's a stock that I believe investors should be wary of because of how low the free float is relative to shares within that same industry.
All right, let's talk about market capitalization since you mentioned it. I mean, it's over 91 trillion naira now. And I remember at some point where Koraga was talking about hitting 100 trillion. It felt impossible at that time, but I don't know. I think that's already happening, or that's going to happen. How soon is it going to happen? I'd like you to comment on that. And then maybe if you could also speak to what does this really mean when we say market capitalization has improved or has increased? What does it mean for the real sector or even for the market and investors?
So for the market cap getting to 100 trillion naira, I mean, when he mentioned it, it was something that we believe could be possible as a result of a number of things. Number one, if there were new listings of stocks or companies on the exchange that bring, relatively high shares outstanding and at a very a good entry price, we definitely see it contribute to market cap. We could also say that another factor that we expected would drive the market capitalization to 100 trillion is the fact that we see some of these stocks re-rated. And that's exactly what, or I would say largely, is what has driven the market capitalization to the current levels that we are now. Are we going to see it come to 100 trillion anytime soon? It's dependent on some of the factors I already mentioned earlier, which is sustained performance of these companies on the exchange. That would really translate to investors re-rating them accordingly. So if they sustain their performance in terms of their financial performance now, we'll definitely see investors, price that in their valuations, and that would increase the market cap of the overall market. And now, what does it really mean for investors? Generally speaking, some investors look for different things in the market. Some investors are dividend-driven. Some investors are just looking for capital gains on the stocks that is invested in. And some investors are even in there for the long run. So the improvement in market cap should not really scare any investor that is looking in the long term, because it simply means that they are well invested in a diverse market, in a large market as big as Nigeria. And if they are looking to hold on to those stocks longer, then they should be examining the fundamentals of the stock. They should be examining the things that feed into the performance of the companies that they are invested in. So it is not necessarily by the number itself. We should be looking at the vibration. We should be looking at how diverse the market is, if it cuts across sectors, and if it presents opportunities for investors to invest in different asset classes. So that is what investors should really be looking out for when we talk about the market cap in general.
All right. I'm not sure we should be talking about the banking sector because, I mean, it's the results are always there. But maybe we should sort of focus on the top 5 performers year to date. Now, we see 2 non-Fugas banks making it to the top 3 year to date. Wema Bank is up over 160%, 162.64% actually, while we're having Stanbic Bank actually at 75.35%. What do you think this is about? Do you see it continuing?
So to be honest, I believe the 2 names are names that investors should really start to look out for in terms of their performance. Stanbic, for one, has no issues with the CBN forbearance, which is something that will deter some of the banks from paying dividend or bonuses as per the circular. But then again, we started to see even the banks that are under the CBN forbearance come out to tell us that they are currently gotten approval and they are expecting to pay interim dividends. So it will be very interesting to see. And that would also drive some level of activity in that space, that in the banking space, if they are looking to still pay interim dividend despite, the circular. It just simply means that whatever they have done in the first half of this year has been able to make them to be able to pay interim dividend regardless of what the circular has said them from doing. Now, that is for Stanbic. Stanbic doesn't fall under that category, so they are quite good in terms of, paying interim dividend when they announce their results. For Wema, we've seen a lot of activities recently, and I believe that this is the performance that we have seen from their record. I mean, in Q1, we've seen that they did as high as over 100% in terms of profit after tax. So that in itself is something that investors, price in, and we are starting to restore them rate stock accordingly. As you rightly said, it is over 100% of year to date, and that just simply explains how much re-rating the stock has enjoyed because of how much improvement that they have delivered in terms of their earnings. So if we start to really look at how these PSU banks are faring in terms of their performance across key metrics, then we definitely see that the interest in the stock of the PSU banks would still be elevated in the minds of investors.
All right, very quickly, let's move on to oil and gas. It managed to add 1.72%, far below the 4th performer. I mean, we're looking at 5 sectors in July, and then, the 4th performer scored 11.14, and then you have oil and gas with 1.72. Do you see recovery moving forward? What's happening there?
So I would expect recovery moving forward. We have 2 giants under that space that are very huge in paying dividends. And that's, again, as you recall, like one thing that I believe investors look out for is stock that pays consistently in terms of dividend. That's Seplat and Aradel. We are very positive on these 2 names in-house, and these 2 names, because of the recent transactions that they have done, they've unlocked a lot of capacity. They've also improved their earnings potential has also improved. I'm talking the Seplat deal. I'm also talking the Aradel deal that has to do with relevance. So all these will bode well if they improve their earnings over the coming quarters, because we still see an upside potential for these 2 names. For Seplat, we recall that it is a fungible stock, meaning that it is dual listed, and there are certain things that even the foreign investors look at that are beyond what we are looking at here and in the domestic front. And if they start to price that in, no investor would want to be left behind when the price starts to move, because we should understand that the transaction that they recently did, that they did last year, or they concluded last year with the mobile, the MPNU deal, is something that would really unlock a lot of value for them. So it is not all the time that we definitely see a bullish run across sectors. There are different sectors that come with different, that have different peculiarities, and those peculiarities would most likely deter them from following what is happening in the market, and that's what is basically happening to the oil and gas right now. Their numbers are still looking good, and we expect them to improve over the coming quarters. And on the back of the improvements that we expect, and also on the back of the fact that these names, some of these names are paying dividends well, then we'll definitely see them be rated accordingly, just in line with what we saw. I mean, last year we were seeing the oil and gas sector, almost topping the chart in terms of performance. But again, as with any market, there are always highs and lows at times when investors slow down just to see if truly there is something that can play out here. I believe the year-to-date performance of the oil and gas sector that is currently negative is largely as a result of performances in Owando and a couple of other names that we don't necessarily track in-house, but then again, if we look at performance, it is not as compelling or as strong as we've seen in other names. So the ones that we are really bullish on are the names that I mentioned earlier, which are Seplat and of course RDL, and because of the transactions and how they would unlock any potential for them, and also the fact that they are dividend-paying stock at the end of the day. So these are the two that I believe investors should really focus on as far as the oil and gas sector is concerned.
All right, Nabila Mohammed, Research Analyst, Chapel Hill Denham. Thank you for your time and your thoughts on the show today.
Thank you for having me.